So today we're going to talk about IPOs. And specifically, there's some takeaways here, whether you're investing in an IPO, you're curious about what's going on with the IPO scene, or you're going to be part of a company that goes through an IPO. Maybe you're lucky enough to do that. I've done that twice in my career. It was a very exciting time. And today, there's two examples that we can talk about. One that just went public last week. You'll be able to search and find a bunch of things on it if you want to dive in even deeper. And one of them is going public, getting priced tonight, and will be going public between the time that I walk off and we put this one up live, and you'll be able to see how that went. Now, here we go. The first one is ARM. They design chips, and they make licensing and royalties off doing that. They're out on the NASDAQ, ARM. Then Instacart. I have a quick update on Instacart. We talked about them about 2 weeks ago. We did a case study all about them. I'm not going to go through that again, but I'm going to tell you what we just found out about their IPO that's going out this week. So first, let's take a look. IPOs are hot again. Here we are in September of this month, and take a look. We had a few in May, and this represents the billions that are raised excluding SPACs. SPAC is a poor man's way to go out public. A lot of companies do that. What I'm talking about, traditional IPOs that go out on the market and result in big money being raised for banks and big money going to the companies that go public on that day. So you can see September, we've even got a couple weeks left here in September, and this is really driven by ARM, and what's coming up is not even calculated in there, Instacart. Now, why are they hot? Well, debt is expensive, and that's just one of the reasons. You can only go public once, usually. You go public, and you can have secondary offerings and things, but you normally go public to raise money for your company. Now, on the flip side, when money is inexpensive, you can raise debt. Tens of millions of dollars in debt. If you're a profitable company and you don't want to go public just yet, you don't want the scrutiny, the quarterly reports, dealing with the analysts, all that kind of stuff, then maybe you back off and you say, you know what, here's what I'm going to do. I'm going to raise some debt. Now, debt, as we look over here, this is LIBOR. LIBOR stands for the London Interbank Overnight Rate, and LIBOR, for 50 years, was how you would measure interest rates most of the time for companies that had, as we would say, paper with a bank, where they would say your interest rate is LIBOR plus 1. So you would look in the Wall Street Journal, find out what LIBOR was, say 4%, plus 1 is 5%, that's your interest rate. Well, at the end of June of this year, they stopped using LIBOR, and now it's going to be SOFR, which is basically Standard Overnight Funds Rate. And there's a couple other abbreviations and a way to look at it, but it all literally makes the same thing. What is the overnight rate that the best credit worthy businesses would receive? And as you can see, from 2021, do you see what the Fed did? Look at this. Look at that. You have to go all the way back here to see that same thing. Even in 2008, when things shot up, it was less than that. You have to go back to 07. We're talking 16 years ago to see the up like this. So that means if you're a business right now and you're going to go out and get a loan, a pretty good loan, let's say you're a pretty good business, and they tell you it'll be at SOFR plus 2, that means here's 5.5 plus 2 is 7.5. That means for every $10 million you borrow, you have 7.5% to pay. That's almost $750,000. Suddenly, that's a lot of interest. So if you're a private company, maybe looking for $100 million to expand a factory or buy a small competitor, you would say to yourself, wow, that's going to cost me $7.5 million a year. So that's $28 to $30 million for over a 4-year period, assuming interest rates stay in this zone, and you are on a floating rate, which is the old LIBOR plus something, and now SOFR plus something. So you look at it like this, and you say, maybe we just go public. If you're strong enough and you're positioned enough to go public, you do it. Otherwise, you may take big debt and maybe pay off some of your early investors at an agreeable thing. Well, this is just one of the reasons, but I wanted to kind of show you the history of debt over 16 years, how it's never been more expensive to borrow money as a company over the last 16, 17 years. So now, let's talk a little bit about ARM. ARM is a unique, very unique, wonderful tech leader. SoftBank actually owns ARM. Well, they did until Friday. Now it's public market, and the people, the shareholders, own ARM. They bought ARM back in 2016. ARM designs chips for almost everybody, believe it or not. Apple, AMD, Qualcomm, NVIDIA. ARM technology and designs are in all sorts of chips that are made by semiconductor designers. Qualcomm makes semiconductors and makes chipsets. You know, the Snapdragon chip. NVIDIA, we know who they are, making gaming chips and AI chips and things. And meanwhile, ARM is sort of the designs that are behind so many of these. Then, ARM chips are in 99% of smartphones. 99%. I don't know why they don't just say all smartphones. I guess there's a couple models out there that don't have it. But it's basically in all smartphones. And by the way, Apple in the United States is a huge percent of smartphones, so no surprise. Then, ARM gets its money two ways. 63% of its ARM revenue comes from royalties. Royalties, ARM gets a payment on chips sold. So maybe that's an ARM chip. There used to be chips way back in the day when we were designing early chips called ARM9s. We're 20 years downstream from those, but they're actually ARM chips that are in there. So if you use one of their chips, they get a payment for every chip sold. Or maybe 37% of revenue from licensing. Licensing, if you're a customer and you made your chips with some of the ARM portfolio designs or their intellectual property, you agree to pay 37%, you agree to pay licensing, and the licensing is 37% of its revenue. So you see, ARM is very, very profitable, very strong company, and they're everywhere. So there's a lot of growth potential here. So ARM goes out, the IPO. How did the first day play out? Well, they put out 95 million shares, and at 51 was about $55 billion valuation. And by the way, that resulted in $6 billion going to SoftBank, but SoftBank only put 10% of the company on the stock market. So if you bought all the shares on the stock market today of ARM, in other words, you took $54 billion, it would be $5.4 billion. It's only about 10% of the company that's out there on the market right now. Then, interesting, Apple and NVIDIA bought shares in the listing. This is called support. So sometimes if you're a little nervous about going out public, you will have some of your customers line up, or key suppliers line up and buy allocations during the IPO, and you tell everybody, by the way, get in on this IPO. I got Apple and NVIDIA buying shares from me. They're going to own corporately. So that's a way to help the IPO get off to a good start from showing key support from key players. So they traded at 55 out of the gate. So wait a minute. Why is it trading at 55 out of the gate when you said 51? 51 per share is what everyone paid ARM the day before it went public. And then when it goes public, the first trade on the market is immediately affected by the market forces of supply and demand for that stock. So the first trade was $55, which means these people were 10% up on the first trade. Then the IPO spike. What's the spike? Well, most IPOs are priced slightly more conservative than market. And sometimes the investment banks intentionally price them very conservative to market so that when it comes out on day one, there's a big pop. And some of those people that owned it at, say, 51, when there's the big pop, they drop them because the 25% spike in this case was almost $69. So if you're in at 51 and you sold on the day of the market, if you were allowed to, because sometimes you're in lockup periods that you can't sell for a while, but if you're permitted to do that on those that goes out, you're holding 51, goes out to 67, you sell it that day, you just made 25% on your money. Not bad for a day's work. And at the end of day two, there was an $85 billion market cap. So this is kind of how it works. You go out on a road show, you're selling it at 51, Apple and NVIDIA say we're in, this is a good thing, we like it, and then the bankers are saying, if Apple and NVIDIA like it, why don't you like it? And away you go. Well, here's what the IPO looked like over those days. Here's that first big jump on day one, and then you can see you get up to a spike here, and then you settle out at $60.75 at the day two. So there you go. See, 51 was your IPO price, 55.54 first trade, 63.59 first day close, quick peak. There's usually a peak in there at 69, and finally 67.5 second day close. Now, I have sitting here, not far from me, Kellyanne. We can't go to you, but can you look up and tell me what ARM is trading in now? ARM stock price. Anyway, she's going to go look that up because now we're sitting here getting toward the end of day 3. And so you'll see where it goes, how the spike comes up, comes down. And so it's going to be down 58, 56. I'd be willing to bet very close to the offering price. So I've kind of stunned her a little bit here. ARM stock price. Anyway, so note to editor, just pause it, pause it, pause it.
Because I can't use the computer because it's on there, so 1 second. ARM stock price.
ARM stock price.
55.43.
Yep.
What is it?
55.43.
Anyway, so look, fortunately, editing note, roll back about a minute. Anyway, with all that, fortunately, Kellyanne is sitting not far from here. And Kellyanne, what is the stock price right now? Because right now we're at the end, almost to the end of day 3 of trading.
It's 55.43.
So 55.43. So guess what? It's almost right back where it was for the first market trade, which means the first 2 days, you pop out some gap to your actual sale price that you sold to everybody before it was on the market. You have some sort of a spike, and then you have a settling as anybody sells out. You know, this is here retail demand. Retail is you and me that didn't get to buy at 51 before the minute before the IPO. We bought on the market. Look at that spike right there. That's the volume. And then everybody just sells off a little bit in there to where we are today. 55.43. We're right back where we were at the end of day 1. And ladies and gentlemen, that is usually how an IPO plays out. So you can see there's a little bit of rigging in here that ends up favoring the insiders, and the retail investors usually are better off waiting for this to settle and to see where it goes from there. But anyway, that's ARM, and that's how the IPO played out. Thank you very much, Kellyanne. Now, we're going to go. How's it going with Instacart? Now you understand a little bit about how IPOs work. Let's look at Instacart. Update. So they're going to price it tonight. So that $51 that was for ARM, boom, they're going to name whatever their number is, and that's the number that everyone is paying tonight. They pay it a minute before the market opens. When the market opens, there'll be some sort of settling effect, which, as you saw, was a little over $55 for ARM. Instacart, what are they saying? 22 million shares will be sold, and our range is now 28 to 30. Previously, we thought it'd be 26 to 28, but they think that the market, with debt being expensive, is really into IPOs right now, and so they've raised their range $2 and to a $10 billion implied valuation. By the way, if you really want to have something valuable, build a chip company. It was $55 billion, right? Huge. Now, at $30, top end of range, you know, the IPO will yield $660 million versus $616. So check that out. That's almost 10% more that they're receiving. And why are they doing it? That is the money that goes to the company. But where is it going? Aha, 237, give or take, could go. Now, the reason I say could is because there's usually rules and a lot of agreements that are made in here based on the actual price, the actual sale, was it oversubscribed, a lot of things that go together in there that triggers whether the investors or insiders looking to sell their shares can actually sell. Now, before you get all excited and say, really, insiders and previous investors are going to be able to pocket $237 million, just remember they raised $2.9 billion over time. So there's a lot of people in there that are going to want their shares to be far more valuable than this, and they hope that Instacart is going up to a bright future. And remember where I said that Apple and NVIDIA were buying ARM shares ahead of the IPO and making sure everybody knew it, because the bankers are out there saying, if Apple and NVIDIA like it, why don't you like it, right? Well, guess what? It was Pepsi over here that bought a ton into this IPO. And lastly, let's all keep in mind on Instacart before we get too excited, the IPO of $10 billion is 1/4 of the $39 billion valuation after the last funding round 2 years ago. So they've got some growing to do to get back to the point where all of their investors can be made fully whole and then some. And that is the update from Instacart. It's going out this week. By the time you're watching this, you'll be able to go back and look at the 3-day chart that we just looked at for ARM, and to see what was the gap. What was the offering price? What was the gap to first trade? What was the spike over the first 2 to 3 days? And then whereabouts did it settle? It's always interesting to me to go take a look at that, and now you know how to look at it. Anyhow, that is what is going on with IPOs this week, and there's a lesson in it from ARM and Instacart, lesson for us that we can apply, whether you're watching it this week in September of 2023, or you're watching it a year from now, and you're basically now looking at a historical case study of IPOs when the market started kicking up a little bit in September. That's what I got for you this week. I hope that was helpful.